Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlet Fu is off today, so you're stuck with me and Eric. Let's get to the biggest stories right now in the more than $13 trillion global ETF industry. As Chair Powell pivots, saying that the time has come to adjust policy, traders gearing up for rate cuts amid inflation data coming later this week. And as the ETF market becomes attractive to more big names, Bill Ackman maybe, could be, perhaps the next one to launch a Pershing Square fund. We'll discuss. And as return stacking booms in popularity, we discuss that strategy with Corey Hoffstein of Newfound Research. But as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, the time has definitely come for QQQ investors in particular. Look at the flows into the Qs, 4.5 billion. They clearly liked what Powell had to say. IWM is back. We saw it taking all this money, then it lost money. Now it's back. We'll see if it's for real this time. And then we've got VU. Now, VU just takes in that money anyway. By the way, VU is 60 billion on the year. The annual flow record is 50, so it's already 10 beyond the annual record with like 5 months to go. Amazing. IVV, same thing. That's from like the retail bid there. This is an interesting one. SPML, it's a momentum ETF from from Invesco rather, and you can see that's about $1 billion there. TLT, I'd argue, Fed-related to a degree, and AGG sort of just takes in the money. Let's look at the outflows. Couple things on here that are a little risk-off. You got SPY with outflows, although 1.6 billion isn't a ton compared to the Qs. DIA, and then this one is a Soxel. The semiconductor ETFs are really in play. Look at the volume every day. 3 of them are in like the top 10 consistently. A lot of people trading semis. Energy outflows, industrials, and a little bit of the leverage Qs. So let's look at what I like to, we have a chart in BI, 2 indexes that we use. ETFs used by buy and hold investors and those used by traders. Buy and hold is here, right? So they take in money, rain or shine, right? Everybody just, it's called the Vanguard bid. This is the trading crowd. Now, they really had a big summer. They were really into the market, but in August, they left, right? That was after the Japan carry trade blew up. The trading crowd kind of pulled out. Then it went flat. Now they're coming back in. So that's a net number there, a couple billion. The retail's come down a little bit, but that's probably short-lived. I expect that to rise up again. So I'm looking to see these two go up in unison, and I wouldn't be surprised, Katie, based on what we heard from the Fed.
All right, Eric, thank you. And let's keep the conversation going now with Sam Huszczo. He is founder of SGH Wealth Management, and the time is now. Let's go back to that concept because we heard Jerome Powell on Friday basically saying, I will cut rates next month. And with that in mind, is it now time to actually rotate into duration? You saw a little bit of love for TLT. Is that sustainable?
I mean, I've been shouting this into the void for like 9 months now. It's like we have a 23-year interest rate and people aren't locking it in. What are they doing? Instead, we saw 106 billion go into money markets. So that's now at 6.24 trillion, an all-time high in money markets that are just going to go down with the ship. The ostriches are getting their heads out of the sand. You saw TLT there is long duration. AGG is a little longer duration. So maybe some people are listening today. But, static yields today dictate 90% of forward returns. And what the futures market's saying is that rates will go down about 1% by year end and another 1% by the end of next year. So we've been doing a 2 to 10 type of ladder with target date maturity bond ETFs. And back in January, that was getting about a 5.5% yield to worst. Today, that's about 4.7. A year and a half from now, that could be at 2.7. So please, look at what's going on and not just get caught up in money markets and everything, because there's a huge opportunity there. So,
you saw I looked at IWM.
Yeah.
This thing, it's poor small caps. They could just never get it going for real, right?
Yeah.
Well, money's coming back in. Can they, is this time for real? Do you think there's an opportunity in small caps, or are we looking at another false positive?
Yeah, I mean, just like my return to Bloomberg here, I think small caps are back. But with that, one interesting wrinkle with it is the S&P 600 only has a market cap of 1.3 trillion. So the S&P 500 is 46 trillion. Yet Microsoft, Apple, Google, Amazon, and NVIDIA all have bigger market caps individually than the entire S&P 600. So a small rotation, percentage-wise, from large to small, is big net dollars for small cap stocks. And so that's where you could see these big pops. There's more upside surprise available for them just because they're so small in market cap in nature.
And so On risk on, you liked HYG, right? This is your ETF. We have bond blocks on pretty regularly.
Yeah.
And they have this XCCC, which is like all triple Cs. It's like,
You love this fund.
I love this fund because if you're going to go in, why not go all in? Why play with HYG when you can go all in? Why not take that much credit risk?
And actually, to clarify, we don't do junk bonds right now, which I think it's funny because like on August 6th, they're called junk bonds, and now they're back to like high yield, sophisticated bonds, But, to get an extra 1.5% in yields compared to investment grade for a spread that's at 3.2%, it's just too much risk for the return. So we don't like it. I mean, if you can stomach a short-term moment, question why you don't just buy the stock. Just own the stock.
But XCCC is like 11%.
Okay, well,
That's a little more.
It is, but those stocks probably have a lot of upside potential as well too. So don't limit your upside if you're going to take that kind of risk. I think the assumption there is people don't capitulate. I'm kind of working with individuals on the retail side more than maybe some of your guys' corporate guests. People capitulate. Politics, geo-warfare, it doesn't just take that their accounts go down to make them get scared and run.
Right. So, okay, It sounds like you're duration risk over credit risk
Yes.
right now. And you asked, what have people been doing? Why aren't they locking in these yields? I'll tell you what they're doing. They're buying buffer ETFs. They are so huge right now as a category, kind of coming to life over the last couple of years, of course, as point of explanation. You give up upside in exchange for capping your downside. A lot of people, Bloomberg Intelligence included, has kind of referred to these as bond replacement strategies. I'm wondering how you're thinking about that.
Yeah, I mean, I've been in ETFs deep for a long time. I'm not a huge fan of the more expensive ETFs in our world. We try to stay on the low-cost side of things. And it might be a little harsh, and there's holes in the argument, but this feels kind of like indexed annuities with cap rates and participation rates, which have been disappointing people for 30 years now. So it's just because bullies are vegans today doesn't make them good. It just makes them less bad. So it's just because it's cheaper than what indexed annuities were. It doesn't make it a use case. And the thing with why I do that parallel is index annuities required you to have a time horizon. You had to hold it for a specific period of time, which again is assuming you don't capitulate along the way to get that insurance factor involved too. But I think a lot of people get on the other end of that and they're like, man, I wish I would have just owned the S&P 500 because I was gonna commit to holding it this time frame anyways.
Well, sort of to that point, I was talking to one of the issuers of these buffered products recently, and we were talking about the concept of having these in your portfolios as your bond allocation rather than actual fixed income. And the point that they made was basically, over the grand fullness of time, stocks usually go up. Why would you put that money in a bond product when you can put this in the slightly safer equity instrument? You're shaking your head. I want to hear
I'm
why.
ready to talk. No,
yeah.
With that, I would say just the environment today in bonds is very interesting because if rates go down, this is just math. This is not speculation. If rates go down 2% uniformly, a 10-year bond has a price appreciation of positive 18%. So we're, just because of how bad 2022 was, the environment is just so much safer to offset any volatility.
Yeah, but that's why I think bonds went down in 2022. When the Fed controls everything, right, they're going to cut rates, so bonds go up, but so do stocks. Well, let's say inflation comes back and the Fed has to raise rates. It's safe to assume stocks and bonds will go down together. So the 60 and the 40 is no longer as diversified as it used to be. And in 2022, the ag was down 13%, not like 1%. It was down almost as much as stocks. And the ag hasn't kept up with inflation. So I just think that these products have this huge opening here with that. And I do think as boomers are getting older and older, they have less time, but they have a lot of money. And this idea of the buffers are almost like a wonder drug. They take all the worry away. And I just think people will overlook a lot to have that feeling.
Yeah, and that was the same sale for indexed annuities as well too. But again, 5 years later, they're like, why didn't I just take the S&P 500 if I'm forced to hold it for that long, So, and the only thing I'd push back on with the bonds, and I'm not like a big bond person or anything like that, but it's just rates hadn't been this high in all those environments in the past that you're talking about. So price appreciation of bonds, that didn't exist. That hasn't existed for a really long time. It's a real possibility, and I'd say that economic downturn, an economic softening maybe a bigger thing to deal with than inflation if the Fed has to make a choice between lowering rates or raising rates at this point. So,
all right, Sam, we don't have much time left with you,
yes,
but I have to talk about single stock funds and
okay,
ask you about them. We had the Defiance daily target 1.75 times long MicroStrategy ETF launched in the last couple of weeks. Last week, it took in $95 million. So clearly demand for what could be one of the most volatile ETFs in the U.S. What do you make of the single stock craze? Because it seems like these ETFs, the only realistic holding period is maybe a day or two.
Yeah, right. And I would say, again, being deep in ETFs for as long as I have, I just used to love how they were just seen as the low-cost product. And we work with clients all the time. Now they have to question, are these expensive products? I akin it to like, having a music artist that you've followed for forever. They were super authentic. Then they get that big contract, and all of a sudden they start going mainstream, and you're like, oh, I missed the old Kanye,
so
basically.
ETFs have sold out.
Yeah, ETFs are in the process. I don't think they're done yet, but as you guys see the flows, most of them are going in this active space and kind of this gambling space of individual stocks and things of that nature. I think what it was born on is efficient, transparent, and low cost. And that's where we try to stay. But, we go up against, we're not taking business from mutual fund people or annuities anymore. So where we're relatively cheaper, we're going up against individual stock pickers. We're going up against Fisher Investments. And we win too. We still win a lot. I'm too over-competitive not to say that. But with that, it's still a great trading tool when these big moments happen. When these big moments happen, you can make a sweeping trade to get into those areas, but you can do that in a less expensive way. I think the times of showing where meme stocks come back and then these kind of products that are interesting, they work, but what's their use case? I'm not quite sure. That's to say maybe there's still a little greed in the market that people are trying to chase to a big degree. So.
All right, Sam, we have to leave it there. Have to have you back soon. Really enjoyed this conversation. Our thanks, of course, to Sam Huszczo of SCJ's Wealth Management. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with mutual fund to ETF conversions. Of course, we've seen a lot of these go through, but if you actually take a look at the flows, they've only taken in about $12.5 billion. That's not nothing, but it certainly pales in comparison to what we've seen go into active ETFs. The top 75 active funds have taken in close to $155 billion. So definitely puts that into perspective, of course, as issuers continue to think about converting into the ETF wrapper. Let's also talk, of course, about NVIDIA earnings coming up on Wednesday. Really have the potential to sort of drive the narrative in the markets from here. As you can see, we have two Granite shares products up, 2 times long, 2 times short. You're taking a look at the shares outstanding here. And as you can see over the past month or so, it's been interesting to watch shares outstanding in both products rise. So plenty of interest in both sides of the trade there. Let's also talk about closed-end funds and specifically the possibility of a Pershing Square ETF. Of course, you'll remember that Bill Ackman pulled plans to IPO his U.S. closed-end fund a couple of weeks ago, and Eric Balchunas and Bloomberg Intelligence out with a note that maybe they'll launch an ETF. I wrote a response to you in the ETF IQ newsletter. Why don't you first start, though, with what the mechanics are, a closed-end fund versus an ETF, because I really feel that's at the heart of the potential disagreement.
Yeah, a closed-end fund, the shares are issued, and there's no way to do, there's no creation redemption process. So the shares trade, and they deviate from the value of the stocks. So people don't like this. It's like a third element introduced to investing. So like Bill Ackman's London Pershing fund is currently trading, I believe, at like a 27–30% discount.
Pretty hefty,
yeah. Now, why is that? Like, you'd think that's a great deal, but it's not always a good deal because it was trading at like a 50% discount, so you could lose money. This was the problem with GBTC. People just want to pay for something for like close to what it's worth, whether you're shopping for a car or a fund. This is why closed-end funds have just been pushed aside on the evolutionary highway. They're like roadkill.
Yeah.
No one launches them, no one likes them. And even he said that his investors were asking, well, I don't want to buy your IPO before it comes out because it might go to a discount. I'll wait.
Yeah.
So he couldn't raise money. And I understand why they would say that.
So the point that I would make, I think we agree that it would solve a lot of problems when it comes to the IPO process, because why would you buy it in the IPO when you can just wait for it to go on sale? But you think about the fact that investors maybe don't like closed-end funds. Issuers love them because you have that pool of permanent capital. And you think about, Bill Ackman and Pershing Square, they haven't been too active on the activism front over the past couple of years. But if they wanted to go down that route again, it probably would be helpful to know how much they have actually under management. Whereas an ETF, everything can theoretically leave in a single day.
True. 2 points on that. First of all, you can sell your closed-end fund. That's why it's at a discount. So it's not totally permanent, but I hear you. The other thing is ETF investors are stronger hands than most people think. Look at Cathie Wood. I know she's seen some outflows this year, but the amount of money that's stuck despite like 2 really bad years in a row. Look at the Bitcoin ETFs. The money is hung in there despite like some really good, big tests of drawdowns. So I just think the investors that go in who are buying his strategy are smart. ETF investors are intelligent. They found the ETF. I think they'll be the money will be stickier than people think. And furthermore, again, the closed-end fund trading at a deep discount. Again, this doesn't reflect well. It's like I'd rather sell your shares even though they're trading below what they're worth because I don't want to be in the fund. I just think ETFs eliminate the third way. And we've got Rubini, Tom Lee, Scott Bessent, all these like heavy hitters are coming into the ETF space. He will be in good company if he launches an ETF.
Yeah, we've definitely seen more high-profile names come into the wrapper. Rick Reeder as well. That was big back when he launched in May 2023. We have to go, unfortunately. I'll see you next block. Eric Balchunas, thank you. Still ahead, we drill down into return stacking funds with Corey Hoffstein. He is CIO and co-founder of Newfound Research. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld. Eric Balchunas is still here with today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at a return stacked ETF. This is a new set of ETFs, a suite of ETFs, return stacked U.S. stocks and managed futures. That's the one we're looking at today, but there's many versions of this. Return stacking is similar to what institutions would call portable alpha. You basically buy one asset class and then you borrow to put the other asset class on top. So it's leveraged. And here we see it's come out about a year ago. 98 bips is the fee. 220 million, pretty big for sort of an indie startup kind of suite of ETFs. Let's look at what it holds. And so you're going to see in here that you're going to see IVV. So that's going to be the ETF you hold. It has to work with treasuries. So there is a, because that is used for collateral. I'll let Corey explain that. And then here's the managed futures. Managed futures is basically a hedge fund type strategy that goes long and short different areas of the market to try to give a non-correlated return stream. So it's almost like you're getting equities plus alternatives in this ETF. Let's look at the returns since it came out, right? And you can see that RSST is up about 19%. So it is trailing the S&P, but the alternative ETF that I put in here, the managed futures, is down. So it's kind of splitting the difference there between those two strategies. But in a sell-off, this one should go up as well. So Katie, interesting new concept here, an institutionalized trade democratized for retail investors.
All right, Eric, thank you. And joining us to explain more about this ETF, I'm pleased to say we're joined by Corey Hoffstein. He is CIO and co-founder over at Newfound Research. And Corey, obviously you're the expert here, but my understanding is that you have to hold this fund for a very long time to see the benefits. And I want to pose that question to you. I mean, what kind of time frame does an investor need to have? Are we talking 5 years? Are we talking decades here?
Well, thank you for having me on, first of all. And I would say it's no different than expecting to see the benefits of holding stocks or bonds, right? These are multi-year trades. Stocks can be up or down in any given year. And the alternative strategies that we're looking to stack on top, things like managed futures trend following, similarly can be up or down in any given year. But we think the combination of adding two uncorrelated return streams, things like stocks and managed futures together, creates a higher probability of being up, even in the short run.
And so, Corey, our colleague Lou Wang wrote a really good article about these ETFs with a very eye-catching headline, which is "Levered Trade that blew up in 2008 gets a $600 million ETF redo." But in the article, as you read it, this is a little different than the kind of leverage that was used in 2008. How is that?
Yeah, in 2008, this trade, which was known as portable alpha, was used among, I think it was something close to 50% of institutional CIOs were putting this in place in pensions and endowments. And what they were doing is they were using a whole lot of leverage, call it 10-to-1 type leverage, to free up room in their portfolio that then they would take that freed up cash and allocate it to hedge funds. And that really had two problems. One, it was a lot of leverage. Two, the hedge funds that they were investing in ended up being very correlated to equity markets in the 2008 drawdown. And then actually the third issue was that when they went to rebalance their portfolios, those hedge funds became gated. And so what we're ultimately trying to solve is that the fundamental concept here of freeing up capital to add a diversifying return stream to your portfolio is incredibly powerful. But we want to solve those other issues. We want to avoid using too much leverage, and we want to make sure that we have this nice liquid structure with which investors can easily get in and out and rebalance their portfolios.
And who are you solving that problem for? I mean, who is the intended audience here? Is it those retail players that we've been talking about, or is this just easier and more free access for institutions that you're envisioning?
Yeah, so this is really for financial advisors, retail individuals, and small institutions. Again, this is an idea that goes back to the 1980s and has been used by large institutions, but it's typically only been those large institutions because it's required a strong operational staff and the ability to manage derivatives. By packaging this into an ETF, we're really trying to democratize access to the concept to everyone who is sort of shielded out of it.
And Corey, just real quick, like 30 seconds, what part of a portfolio does this go into? If you're talking to a 60-40 type investor, what are they selling in order to put something like RSST in their portfolio?
And that's actually the problem we're trying to solve, Eric, is typically to get something like managed futures, you'd have to sell stocks or bonds. And it's in a process of addition through subtraction to get diversification into the portfolio. Here, if you're a 60-40 investor, you can sell some of your stocks, buy RSST. It's going to give you that large cap stock, U.S. stock exposure back, and then add managed futures as an overlay. And we think that's an incredibly powerful concept.
All right, Corey, great to speak with you. Have to have you on for longer next time. That, of course, is Corey Hoffstein of Newfound Research. And a quick programming note, because of the Labor Day holiday, we'll be back next Wednesday, September 4th. But that does it for now for Bloomberg ETF IQ. I'm Katie Greifeld along with Eric Balchunas, and this is Bloomberg.